Charlie Munger, who was one of the wisest people and greatest investors of our time, wasn't a fan of buying stocks simply because they looked cheap. He thought that too many investors only care about finding bargain bin stocks and don't pay any attention to whether the stocks they're investing in are actually worth investing in, which is a mistake. Instead, you should strive to only own high-quality companies even if they're not trading at a super deep discount. Or in other words, it's better to buy great businesses at fair prices instead of fair businesses at great prices. And in this video, we'll be talking about 3 great businesses that admittedly aren't the cheapest, but are still worth the premium price tag by far. And actually, this first company we're talking about here was one of Charlie's favorite companies. Now, starting here with Costco's share price performance, they've actually seen a slight correction in the last month. They're down 6.6% in the last 30 days, but still, they're up a pretty considerable amount across every other time period. Looking at the year-to-date performance, Costco's up over 8%, so that's pretty nice. Looking over the last year, Costco's up 47%, very delicious. And if we zoom out across an even longer time period over the last 10 years, they've seen a very substantial surge, up 610%, which is no surprise, seeing as Costco's financials have seen tremendous growth over the years. Looking at some of the financial stats over the years, we can see really solid growth in revenue, earnings per share, and free cash flow. And more specifically with those numbers, the average revenue growth across the last 10 years is 8.72%. So every single year on average over the last decade, they've grown their revenue by this 8.72%. Looking at the earnings per share growth across this time period, on average, it's grown by 13.13%, and the free cash flow over the last 10 years has grown by an average rate of 12.72%, which is very impressive. And this has enabled Costco to grow their dividend by more or less the same amount here. If we look at the dividend stats, the starting yield is not the highest. This is a very low yielding stock coming in at 0.6%, but everything else is looking great. They have a very low payout ratio. The 5-year growth rate, like I said a moment ago, is pretty similar to that average free cash flow growth rate. It's coming in here at 12.34%, so a nice double-digit dividend growth. We like to see that, and they've been consistently growing this dividend for almost 20 years. Now, although Costco is definitely not trading at bargain bin prices, like I said, this is a great business that is definitely worth paying up for. It has a few key competitive advantages that I think are worth mentioning. The first is that Costco operates on a membership model where customers pay an annual fee to access its stores and take advantage of bulk buying discounts. Now, obviously, this is different than most other grocery retailers where you don't need a membership, but this membership is a really solid source of revenue for Costco and allows the company to maintain lower prices for the products they sell, which is obviously a huge draw for the customers. Additionally, because you have to be a member to even enter the store, theft and crime is not a big issue for Costco at all, especially compared to other places like Walmart or Target or pretty much any other retailer where the level of theft has been pretty concerning. So the membership fee also helps keep bad actors at bay. And another interesting thing that I've noticed about Costco is there is quite the craze about them on social media. If you go on TikTok or Instagram or even YouTube, you'll find that there are entire communities dedicated to all the latest finds at Costco, and you don't really see the same thing happen when it comes to Walmart or Kroger or Albertsons or most other grocery retailers. The only other one that I think generates this type of craze on social media is Trader Joe's, which I wish was publicly traded. At any rate, like I said, Costco is definitely not the cheapest stock out there, but I think that if you were to even buy it at today's prices and just hold on to it for a long period of time, you'll end up compounding your money in a pretty big way. Now guys, Visa is hands down one of my favorite companies, and I've actually been buying this one every week for the last handful of months. If we take a look at my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. We can see here that I have about 14.5 shares of Visa at an average cost of $272.28. And with the current share price only a few dollars above that, I'm still happy to continue accumulating shares of Visa at this point. But still, Visa is not by any means sitting at bargain bin prices. Looking at the share price performance here, Visa is down just a little bit in the last month. Nothing too crazy. They're only down about 1%, but year to date, they've still seen a bit of a climb. They're up about 6.5%, and looking over the last year, it's even better. They are up 21.5%, but then zooming out once more over the last 10 years, Visa has seen a substantial surge of 461%, which like Costco is not surprising because Visa is also a growth machine. Looking at the charts here, revenue, earnings per share, and free cash flow are all going up into the right as the years go on, which is exactly what you want to see. And getting into the specific numbers, the average revenue growth over the last decade is about 10.7%. So that's very nice to see. And also the earnings per share growth is very sweet too, 15.8%, which is even higher than the average revenue growth. So Visa is becoming more profitable as time goes on. And the average free cash flow growth over the last 10 years is also looking great. This has grown by an average rate of about 9.1%, which has also helped them sustain pretty aggressive dividend growth over the years. Looking at the dividend stats here, just like with Costco, Visa is not a high yielding stock by any means. The forward dividend yield is 0.75%, so nothing to write home about there, but everything else is looking great. Payout ratio is very low at 21.6%. The 5-year growth rate is incredible at 16.1%, and they've been growing this dividend for the last 15 years. Now, having said that, with both Visa and Costco, you might be turned off by these low dividend yields. Both coming in sub 1%. You might look at that and think that the cash flow return isn't worth it from these stocks, but that's where time in the market becomes such an important factor in investing, especially when you're dealing with dividend growth stocks like Visa and Costco. Thanks to the ample dividend growth offered by both of these companies, over a number of years, your yield on cost will skyrocket and your cash flow return will just get better and better with time. And we can actually see how this has played out over time. If you would have bought shares of Visa, 10 years ago, back in April of 2014, your yield on cost today would be 4.23%. So a lot higher than the starting yield, but that's why dividend growth is so important because, like I said, over time, just by holding on, your cash flow return will continue to increase. And by no small amount either, and as time goes on, the yield on cost here, this 4.23%, will continue to just get higher and higher. Now, once again, Visa is not the cheapest stock out there, but I think this is a fantastic business that is worth paying up a bit for multiple reasons. First and foremost, this is probably one of the most high margin businesses out there. If we take a look at that, guys, over here on the income statement, the gross profit margin is just incredible. In the trailing 12 months, it's extremely high at almost 98%. So very good to see. And if we scroll down even more, looking at the operating margin, this is also high. It's 67.3%. I love to see that. And if we scroll down all the way to the bottom line, looking at the net income margin, it doesn't get any better than this. In the trailing 12 months, the net income margin was at 54%. And if you were to see a gross profit margin even this high, that'd be impressive. But the net income margin at 54% is just, you just can't beat it. So in other words, more than half of the money that comes into the business, they get to keep after accounting for all of their expenses. That's insane. They run this thing very efficiently. And as time goes on, it becomes even more efficient. You see, Visa is the largest payment network in the world, considerably larger than others like MasterCard or Amex. And the vast global scale of Visa's network allows the company to process an enormous volume of transactions pretty efficiently, which we saw from the margins a moment ago. And the more transactions that run through their network, the more efficient it becomes. This is because Visa has certain fixed costs with operating and maintaining its network, and these fixed costs don't change. So as the volume of transactions increases, these fixed costs are spread across a larger number of transactions. The more transactions processed, the lower the average cost per transaction. Hopefully that makes sense. And as time goes on, people are paying for things less with cash and are paying for things more with their card, which means that the number of transactions processed on Visa's network will continue to grow. So the demand for their network will continue to increase, which expands their competitive advantage even more, and that will be a difficult thing to intrude on, especially considering it's already the largest and most trusted name in the space. Overall, when it comes to great businesses, Visa is like at the top of the list for me. I'm personally happy buying at today's prices, and this is one company that I just can't get enough of. Now, Rollins is a bit more under the radar than the first two companies, but this is definitely one worth looking into. In case you've never heard of it before, Rollins is one of the world's largest pest control companies, and they service customers in over 70 industries around the world through various subsidiaries of theirs, such as Orkin, Critter Control, and Clark Pest Control, which was my local pest control company growing up. And if we look at the share price performance, Rollins is up across all time periods. In the last month, they're up nearly 2%. Looking at the year-to-date performance, it's a bit higher, coming in just under 4%. Looking at the performance over the last year, it's done pretty well, up 17.6%. And if we zoom out over the last 10 years, the returns are very impressive. They've seen a climb of 417.5%. And although Rollins isn't as big and well known as Costco or Visa, its growth is just as impressive. And if we take a look at the charts here, it's going to look pretty similar to the first two companies. Revenue, earnings per share, and free cash flow are all going up and to the right. And getting into the specific numbers, these are pretty sweet as well. Looking at the average revenue growth over the last last decade. It's grown by an average rate of 8.7%, so that's nice to see. The average earnings per share growth is growing even faster at 13.6%, and the average free cash flow growth is right there with the earnings growth. This has increased by an average rate of 13.14% over the last decade. Now, looking at the dividend stats, I think these are going to be the best out of the bunch. The yield is certainly the highest, coming in at 1.3%. With that, though, the payout ratio is the highest as well at 60%, but still, that's not too bad. The 5-year growth rate is also very nice, coming in just below 17%. Really like to see that. And they've only been growing this dividend for the last 3 years, but they've been paying it for even longer. If we look a bit deeper into the dividend history, we can see that despite only 3 years of growth, Rollins has been paying their dividend for over 3 decades. So the consistency is definitely there. Now, while pest control is definitely not one of the most exciting businesses out there, it's very predictable, and it's one of those things that's always going to be needed. There will always be critters to keep under control, and so pest control companies like Rollins tend to have steady demand regardless of what's going on in the economy. Whether it's residential or commercial clients, people will prioritize pest control as part of property maintenance because no one wants to deal with things like ants and spiders and termites. But anyway, because of the steady demand for its services, Rollins has managed to increase their sales even during difficult periods like the Great Financial Crisis when all the COVID stuff was going on. That's a huge green flag for investors. And another one is the amount of recurring revenue this company generates. At this point in time, 80% of their pest control revenue is recurring, which certainly bolsters the predictability of this company. So despite not being the cheapest, I think Rollins and all 3 of these companies are fantastic, high-quality businesses that are worth buying today and just holding on to for dear life. But still, if you are looking for something a bit more discounted than the 3 stocks we talked about today, then fortunately, I've got 3 more stocks in this next video right over here that I think will be more up your alley. These 3 stocks are deeply discounted and in my opinion look like fantastic ones to buy right now in the month of April. So click right over here to check them out, and I'll see you in the next one.